Welcome to New Money. I'm Bryan Hirsch, and in tonight's episode we are delving into retirement and financial planning with focus on crucial aspects of securing your financial future. It's deeply concerning how many individuals have withdrawn from their retirement funds following the implementation of the two-pot system on the 1st September 2024. According to the Actuarial Society, 75% of applications received in the current tax year between March and April were repeat claims. Furthermore, they noted that the main beneficiaries of these withdrawals may have been loan sharks, as banks have not reported a significant reduction in outstanding loans, nor have retailers seen a notable increase in sales. The latest figures indicate that 62 billion has been withdrawn, with 13 billion paid in tax. It's important to understand that only individuals who are gainfully employed are eligible to make these withdrawals, as only they would be active members of a retirement fund. And joining me to make some sense on this is Leseka Monering, Managing Director, KLU Wealth and Legacy Management, and Jordan Toy, Director, Legacy Family Wealth. Good to have you both on the show. Gordon, my first question to you, have you had any clients who have taken advantage of the two-pot system? And if you have, has it been easy to withdraw?
So fortunately, some of my clients have looked at it, but none of my clients have actually gone ahead with it. And I say fortunately because I think we're likely all in agreement that the more funds you can preserve for retirement, the better. I do work with several group schemes, and there's lots of discussions around, how the whole process works. So, I think everyone is quite familiar, and I see that recent survey data that came out, there was sort of information that everyone is quite familiar with the two-pot system now. For the most part, people are familiar with the rules, the negative implications around it as well. But fortunately, most of my clients have sort of looked at it and gone, you know what, the growth that we're getting and the preservation of those retirement savings is going to be much more powerful for me in the long term, provided that your financial circumstances allow for you to avoid that withdrawal. So fortunately, my clients, for the most part, so far, have avoided making two-pot withdrawals.
Leseka, I'm going to ask you the same question. Have you seen any increase in that? But I'm going to ask you a second question. I'm absolutely amazed. You go back 10 years, the pension reform ability to make individuals preserve their funds until retirement. And I don't think many individuals are aware that all contributions made after the 1st of September is the two-pot system. One pot going, 2/3 going to your retirement, and you cannot draw, even if you resign from a company, it's preserved till retirement. The 1/3, yes, that goes into the savings pot and you can withdraw it. So the two questions are, have you seen any take-up on the two-pot system with your client base? Because I can tell you I haven't seen with any of my client base. And then this question about preservation. Do you think people are aware? And let me just clarify, anything up to the 1st of August can be withdrawn.
Yeah.
That's vested, no changes. But going forward, I think it seems to have just sneaked in.
So, it's very interesting. So, I think similar to your practices, I've had one client that's made use of her two-pot. And interesting enough, she's also she's made two withdrawals. So, we made one last year and this year. So I think it definitely affects different parts of the economic scale in South Africa. So I think people that were desperately needing funds or access to funds are making use of it. But certainly the clients that are working, that actually understand the implications if you take into account the tax, the after-tax amount, and the fact that, you don't really get much out of it, really. I think that's the positive thing about it, that people understand that it's actually really for retirement withdrawals and that it's not meant to be accessed in the long run. And to your point about the preservation, I think what I've seen is that clients are understanding that, they need to preserve their funds for retirement. In actual fact, we already have a crisis. So even the funds that are in retirement funds are not sufficient to actually get their clients through retirement. So I think there's some progress in terms of financial literacy in saying that they understand that they're not sufficiently providing for retirement, but a lot more work needs to happen. So we need to get into the, so I've also had clients where you speak to them about their own pension funds at work. They have no understanding. They don't know what the balance is. They don't know how much they're contributing. So a lot more work still needs to happen. But I think the point that we're also trying to see is that when clients know better, they do better. So I've seen it with Two-Pot. They know it's not really worth their while, and because of that, they then tend to not withdraw. So a lot of work still needs to happen to have correct conversations about education and have people understand how these things work.
Jordan, we've had, I can't believe, but next week it's 6 months. The year's halfway through. As a matter of fact, I love the winter solstice. Because for me, the 21st of June starts to tell me we're starting to move down into spring and summer, and I love that. But it has been a very volatile 6 months, and I always say people who don't look at their portfolios regularly didn't even see what actually happened in April, because we had that V recovery.
Yep.
And if you look at markets today and you look at performance, if you looked at your values at the end of December and you look at them now, you're very close, if not making a profit. I think portfolio is up about 5.4% for this year, which is not bad if you think we can end the year with 8 or 9, 10%. But is this, do your clients get statements every month? And have they been able to see these great fluctuations, which is really, I've always said, is not driven on fundamentals, it's driven on sentiment, the news of the day. What happened on Friday, markets are down. What will happen today will determine whether the markets will be up. But if you think of the top companies throughout the world, they have no effect of what's happening in the Middle East or in Russia and Ukraine. It doesn't really affect the companies, but on the day-to-day. But how have you dealt with these issues over the last 6 months?
Yes, certainly, Brian. I mean, it's been if you'd read just the headlines, like a summary of the headlines we've seen over the year, you would think that markets would be down sort of 10, 20, 30%. And I think that speaks to sort of noise in the markets versus what's actually going on the ground. You talk about these companies and how impacted they are by what's going on in the Middle East or what's going on in Ukraine. And the impact is often limited maybe to a specific company or a specific sector, but you get this sort of broad-based effect across the market where, everything sells off. So in terms of our clients, I think it's always a challenge, right? Even as professionals dealing with volatility, it's unsettling and it's not pleasing to see one's investments falling in value. But you talked about it, and I think the key thing to look through is, if you'd exited and tried to sort of start timing the market and gone into cash, the chances of you getting back in time to catch that recovery is very low, or you've missed a significant portion of it. And what we constantly try and do is, the past isn't necessarily a guide for the future, but it gives us an idea of how markets have behaved previously. And sort of the COVID V-shaped recovery is a perfect example of that often you have the sharp drawdown and sharp recovery in markets. And we've looked at lots of numbers on this, and and we've talked about it before as well, is a lot of the best days in markets come very shortly after some of the worst days in markets. So it's all of this data that we're trying to sort of illustrate the principles in terms of long-term investing and staying the course through that volatility. The longer time period you look over, the smoother that line becomes. So, to look at ones, and you ask about client statements, our clients do get statements regularly. I think quarterly is a more reasonable period to look at your investments over, but clients are nowadays with technology, clients are able to log in, they can view their account day to day or minute to minute. So it's just about managing that, and I think nowadays a lot of the information, it's almost information overload. So it's become less a case of getting all the information at your fingertips and more a case of deciphering and interpreting what that means, and is this something we act on or is it something we don't act on?
Your experience the last 6 months?
Sure. So it has been volatile, Bryan, and I mean, exactly to Jordan.
Well, we see it volatile because we watch it daily.
We do.
I mean, that's our business, to watch daily.
Exactly. And we've also gone through the emotional, what is this, what's happening and why is he saying what he's saying, why is he doing? So it's naturally, it affects your sense of security. You do feel a bit uncomfortable with volatility. But there's some interesting research that also proves that clients who have advised advisors, someone that can actually speak through the nonsensical aspect of, you know, what is relevant, what is rational, what is not rational, that they actually have a better outcome in terms of investment. So if you have a DIY client who is looking at their portfolio, who is naturally going to panic when things are going badly, they actually lose out on long-term performance. So it actually is valuable to have someone to speak through the volatility, what's real, what isn't real, how long are we expecting it to happen. And sometimes we know, but we help clients actually nurse some of these emotions that come with it. But to your point, I mean, if you look at the numbers, even with all that's happened in the last 6 months, everything, all the asset classes are double-digit returns except for cash. So if you were not invested, you would have lost out over the last 12 months. And we're talking double-digit kind of returns. And those are important if you're trying to beat inflation in the long term. So it's actually very opposite to what you're feeling. So markets don't respond to our emotions. They don't respond to our panic. And also it's too late to panic. So then so we need to be having very different conversations. And volatility is a very small aspect of what we need to be conversing and using.
You know, Lesego, I always say we're financial advisors, and people take our advice or don't. They take part of our advice. We're sometimes financial nannies, where people say, look, I don't understand, share with me. And we have to make sure that they do understand, and then we become financial psychologists.
Absolutely.
I think that's the most important thing. And it's worth, I mean, when you think about how much you have to pay for a psychiatrist or a psychologist,
Exactly.
and you compare how much you pay us for holding your hands through the bad times. Because, you know, we've had, in the 20s, we've had 3 difficult markets. We had firstly COVID at the beginning of 2020. We then had interest rates and the Russian war in Ukraine. And now we've had what's going on in interest rates weren't going to move. Then we've had the tariffs. We've had quite a 5-6 years of some real stressful moments. And yet the markets have performed. So why do people panic? When I come back, before we take our emails, I want to talk a little bit about risk, because it's a word that people hear, but I don't know if they really resonate and understand exactly what it is. But we're going to take a short break. Stay tuned, and we'll be back shortly.